welcome back to this week's market update. Today is Friday, August 4th, 2023. This is Kelly coming to you with another exciting week full of economic updates. So let's jump right into it. So this week was marked by pretty lackluster earnings, as well as the first Fitch credit downgrade of the United States, which sent markets into a place of uncertainty. As of close on Thursday, the Nasdaq Composite sunk 2.7%, the S&P 500 lost about 1.9%, and the Dow Jones Industrial Average weakened just about 1% in this first week of August here. Shifting gears into our more economic updates of the week, we had the July ISM Manufacturing Index come in lower than expected at a pretty bearish 46.4% this month, which is slightly up from June's numbers there, but definitely a significant downtrend. As you can see, last summer we were at about 52, and we've been slowly working down with a few up and down months in between. I think also in this report, we saw that this was the 9th consecutive month of contraction following the prior 28-month period of growth. So it's definitely a significant shift in the manufacturing industry that we're seeing through things like these manufacturing PMIs. Also in this report, manufacturers noted that they are experiencing weakened new orders, slimmer backlogs, and faster delivery times. And this is all generally pretty correlated with economic cycles. So when we see contraction in the manufacturing industry, we also tend to see contraction in other industries, and that kind of supports the bearish take on the current economic environment. Along with the ISM Manufacturing Index, the ISM Services Index came out on Friday and also was below estimates. Came out to 52.7% for the month of July, down over 1% from June's numbers there. Now, this is not a super significant drop there just because it does tend to flow up and down in between months, but we have been trending downwards since, the 56, 55 range that we were in this time last year. Even before that, in 2021, we saw ratings above 60. So we are trending down over the last 38 months of growth, but we are still in positive territory. So we'll continue monitoring things like the ISM services and manufacturing indexes to get kind of a good read on the economy and see if any portfolio changes are necessary per the mandate of each portfolio. Also in the news this week, as if the Federal Reserve's actions towards rising interest rates weren't already putting pressure on the federal government's deficit management, the credit rating Fitch downgraded the U.S.'s credit rating from the highest rating, AAA, to just AA+, which is only one down in their scale, but it does mark a significant shift for the U.S. The credit rating cited that the expected fiscal deterioration over the next 3 years was the primary reason for this downgrade, as the country's annual interest payments near the $1 trillion level. So you can see here just the annual interest payments over the last decades and decades here has slowly trended up, but then since the pandemic, we have really ticked up with higher interest rates and higher borrowing. Is this a major cause for concern right now? At this point, no, but it did certainly surprise the equity and bond markets, however, only affected market rates towards the end of the yield curve at this time. In the world of fixed income, this was a big shift for the 20-year U.S. Treasury yields. They began the week near 4.2%, sorry, and ended the week towards 4.4%, which does mark nearly a 5% increase in yield within just a few days. Looking forward, though, the U.S. will likely face higher interest costs continually as the new issue rates feel upward pressure, at least while the Fed is in this tightening stance. So will it affect the U.S. longer term? Yes, probably. However, it is no cause for concern right now. Moving past the more bearish data of the week, on Friday morning we got another month of robust labor market data demonstrating a quite resilient job market. So we had non-farm payrolls come to 187,000 jobs in July, which was slightly below expectations, but still a great number in terms of longer-term averages. On the other hand, we saw average hourly earnings pick up about 0.4% in July, faster than inflation, and this is something that could feed into some stickier inflation in the coming months. But as of right now, good for the workers that wages are increasing. Most notably, though, the unemployment rate in July fell to just 3.5% again, which is 10 basis points away from an unemployment rate that dates back to 1969. So excluding these 2 months here where we had that 3.4% unemployment rate, The last time that we've been able to withstand an unemployment rate this low for a longer period of time has been in the late 1960s, so quite historically low in unemployment. The 1-year percent change in unemployment, which tends to pick up trends a bit more efficiently than the standalone nominal unemployment rate. Currently, the 1-year change in unemployment remains pretty neutral, near zero over the last 6 months or so, but it has been trending up since early 2021 here. But this also could be related to COVID. So, a lot of this data is kind of reverting from these crazy increases in unemployment following the pandemic shutdown. But we see, it has been trending upward. And, will it continue to just kind of stay around here, or will it continue its track up? That's really what we're watching. But important stuff to look at as we take kind of a holistic macroeconomic perspective on the markets. So, a very exciting week in the markets, lots of stuff going on for the bulls and the bears, but we will continue to keep monitoring very closely, and we look forward to seeing you next week.